What if I told you that the greatest risk to your money isn't the stock market or a financial crisis or even a scam? It's you? That's right. The biggest reason people fail at investing isn't bad luck. It isn't that the market is rigged. It's human behavior, fear, greed, impatience, and overconfidence. The market has made countless people wealthy over time, but it has also drained the life savings of millions. The difference between the two isn't the economy, it's psychology. So let's uncover why most people fail at investing, and more importantly, how you can avoid the traps that catch almost everyone else. Think about money for a second. We trade our time, our energy, our lives for it. Then, when we save it, we want it to grow. But here's the catch. Keeping money safe in a bank account doesn't really keep it safe. Inflation quietly eats away at it. $100 today won't buy what it did 10 years ago, and in another decade, it'll buy even less. That's why investing isn't a luxury for the wealthy. It's a necessity for anyone who wants financial freedom. But here's the shocking truth. Most investors, even though they enter the market with good intentions, fail to get the returns they could. Not because the system is broken, but because they panic when they should stay calm, they chase when they should wait, and they gamble when they should plan. Let's break down the 5 biggest reasons people fail at investing and how you can flip the script in your favor. 1. The fear trap, selling at the worst time. Imagine this. It's 2008. The financial crisis is everywhere. The stock market has lost nearly half its value. People's retirement accounts are cut in half. The news is nothing but doom and gloom. Millions of investors sold everything. They couldn't handle the fear. They thought the system was collapsing. But here's what happened. Those who sold locked in their losses. Those who stayed, they not only recovered, but went on to make some of the best returns of their lives, because the market eventually rebounded stronger than ever. This isn't a one-time event. It happens in almost every downturn. The Great Depression, the dot-com bust, the COVID crash of 2020. In every case, history rewarded the patient and punished the panicked. Fear makes people focus on the short-term pain while forgetting the long-term trend. It's like being on a roller coaster and jumping off at the scariest moment, instead of holding on until the ride levels out. The lesson? Never let short-term fear destroy long-term growth. 2. The greed trap, chasing hot tips and quick gains. Now let's talk about greed. Think about the dot-com bubble in the late 1990s. Everyone wanted internet stocks. Companies with no profits, no real business models, were valued in the billions. People thought they'd get rich overnight. And then it all collapsed. Fortunes disappeared in months. Fast forward to the crypto boom of 2017 or the meme stock mania of 2021. Same pattern. The majority of latecomers who bought in at the peak, driven by hype and FOMO, ended up losing money. Greed whispers, "Don't miss out. This time is different. This is your ticket to wealth." But more often than not, those who chase hype end up being the last ones in line, the ones holding the bag when the music stops. Think of investing like farming. You don't get a harvest by digging up the seeds every week or by rushing to plant in someone else's field just because they said it's hot. You get it by planting, watering, and waiting. Real wealth doesn't come from chasing the latest shiny object. It comes from steady, consistent growth. 3. The overconfidence trap, thinking you're smarter than the market. Here's a sobering fact. Even professional fund managers, with armies of analysts, access to insider-level research, and cutting-edge algorithms, fail to beat the market consistently. Yet countless everyday investors believe they can time the market. Buy low, sell high, repeat. It sounds simple, right? Except nobody knows exactly when the market is at its lowest or highest until after it happens. Overconfidence leads to dangerous bets, pouring too much money into one stock, trading too often, or ignoring diversification. And while that might feel smart in the short term, over time it usually backfires. It's like trying to predict the weather down to the exact hour 3 months from now. You might get lucky once, but long-term success doesn't come from luck. It comes from systems. The people who win in investing aren't the ones who try to outsmart the market. They're the ones who respect it, stay consistent, and avoid overconfidence. 4. The lack of a plan, investing without purpose. Here's another reason people fail. They have no plan. They invest without knowing why. They buy stocks because a friend suggested it, or because they saw it trending on social media. They pull money out when things look bad, without considering how it affects their bigger picture. But investing without a plan is like driving without a map. You may keep moving, but you're not going anywhere meaningful. The truth is, investing works best when it's tied to a purpose. Are you investing for retirement? For your kids' education? To buy a home? To create generational wealth? When you define your goal, your strategy becomes clearer. Long-term goals often mean safer, diversified investments like index funds. Shorter goals might mean lower-risk bonds or cash savings. Without a plan, every market dip feels like a disaster. With a plan, it's just part of the journey. 5. The patience factor. Why time in the market beats timing. The market. This might be the most important lesson of all. There's a famous saying, time in the market beats timing the market. Take Warren Buffett, one of the world's most successful investors. His greatest strength isn't just picking good companies, it's holding them for decades. He once said, "Our favorite holding period is forever." If you invested $10,000 in the S&P 500 in 1980 and simply left it alone, reinvesting dividends along the way, you'd have hundreds of thousands of dollars today. But here's the kicker. If you missed just the 10 best days in the market because you sold out during panic, your returns would be cut almost in half. Patience is a superpower in investing. The people who win aren't the ones who react the fastest. They're the ones who sit tight and let compounding do its magic. Albert Einstein reportedly called compound interest the eighth wonder of the world. He said, "He who understands it, earns it. He who doesn't, pays it." This isn't just about stocks or bonds or real estate. This is about freedom. Every dollar you invest wisely is a step toward buying your time back, toward being able to wake up one day and not work because you have to, but because you want to. Think about it. Money isn't really about money. It's about security, dignity, choices. It's about knowing your kids will be okay. It's about not being trapped in a job you hate just to survive. Most people fail at investing because they let emotions control them. But you? You can choose discipline over fear, patience over greed, strategy over randomness. Your future self will thank you for it. They let fear drive them to sell low. They let greed push them to chase hype. They believe they can outsmart the market. They invest without a plan. And they lose patience right before the rewards arrive. But you don't have to. You can avoid these traps by building a clear plan, staying consistent, and letting time and compounding work in your favor. The question isn't, is investing risky? The real question is, can you afford not to invest? Because doing nothing might be the riskiest move of all. So, what if your money actually worked for you? What if every dollar you put away today was a soldier building your freedom tomorrow? The best time to start was yesterday. The second best time is today. Maybe it's time to rethink how you see the future and how you let your money shape it.